In May of 2020, FreightWaves Live is headed back to the largest freight market in the Southeast, Atlanta, Georgia. Join FreightWaves for our best event yet, featuring captivating keynote speakers and rapid-fire demos of technology that is sure to take our industry to the next level. This is your opportunity to interact with some of the most innovative leaders as we mark a new decade in transportation. See you in Atlanta May 5th and 6th.
Hello and welcome to this Wednesday edition of FreightWaves Now. I'm your host Anthony Smith, and we're keeping things rolling this week. So we have Luke Falasca coming up next, talking to the brokers. I'm coming in, talking to the shipper, a little bit of an econ update. But first, a word from Strickland with a carrier update brought to you by Powerfleet.
Hey everyone, and welcome to the Carrier Update on this Wednesday presented by Powerfleet. So, tender rejection rates continue to fall throughout their barrier, dropping below 8% for the first time this year. We thought that, we saw this little hang up here in the middle just a few days ago, and then we thought, that's not going to last either. And it did. It continued to fall. Spot rates itself, this green line right here, spot market rates have continued to fall as well. So capacity is returning to the market as we anticipated, and it should continue to do so throughout the month of January. So let's look at the country, see where things are hopping, see where things are not hopping. So again, the Midwest continues to be pretty disappointing in terms of overall capacity, or loosening in terms of if you're trying to find freight out there and you're stuck in the middle of the Midwest, you're probably not going to have a lot of opportunities on the spot market today, except for this little stretch of area right here floating through. And we just had some weather hit this little stretch of, not a significant snowstorm, but it did hit this area around DC, West Virginia, etc., dropping a few inches of snow around there. Didn't disrupt things that significantly, but still might be enough to create a little bit of capacity disruption in this area. But all the way back here in the Louisville market, these darker blues indicate tightening conditions. So this is the weighted rejection index, which takes into account outbound tender market share along with the weekly change in tender rejection rates. So anything in that dark blue means that that's going to be one of the more significant tightenings in the market. Anything in the red, again, we're talking loosening conditions. So this Louisville market right here, along with this area up here in the upstate, Wisconsin, Minneapolis, Minnesota, continue to be some of the tighter spots in the country. We look out west. This area of dark blue here in the middle of the country still continues to have trouble, struggling to get some capacity going in that area. A lot of these hinterlands, not a lot of volumes coming out of these markets. That's why you don't see these tall, super tall market in these areas. LA continues to be red, but also one of the bigger markets in the country, but it is declining. So let's take a look at the Louisville market. Louisville tender rejection rates, contrary to the rest of the country, really starting to spike up. And what's the length of haul that we're looking at in terms of, where are these tightening loads coming from? Well, that's the tweener market. Anything moving from about 450 to 800 miles in length. So that means that for the carriers out there that are willing to drive, you should have increased opportunities in this area, especially if you're heading in there over the next couple of days. So check the spot market and the load boards in this area. If you are heading into the Louisville, Cincinnati area, you might need some freight to keep rolling. And tweener loads are really good, high revenue loads, not a lot of minimums going on there. So make sure that you check that market out. Mid-haul, also starting to see capacity tighten in that area. All length of hauls are actually increasing in that area. So even if you're a regional carrier, check out the Louisville market over the next little bit. I wanted to talk a little bit about the Los Angeles market. You saw it over there in red, and it is still one of the largest markets in the country, in Ontario and Los Angeles, accounting for roughly 6 to 7% of total load volume in the country. But that is a diminishing return right now. You see, we've got the outbound tender volume index pulled up behind me for both the Ontario and Los Angeles markets, and you can see the trend is really just collapsing as we enter, the fourth quarter of last year. And it's probably going to continue to do so. Now, the reason I mentioned this now is because we have the Chinese New Year that's going to hit here in the next couple of weeks. Surging freight volumes could happen locally around that area. It did create a big impact last year as we saw all that freight being pulled forward. We do not anticipate the same thing this year, but it will be a market to watch here in the next few weeks. And thanks for watching today's Carrier Update.
The comprehensive logistics offerings from Powerfleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with Powerfleet.
Hi everyone, I'm Luke and I'm bringing you your broker update for today. We've got tender rejections still falling in the market, so we're going to take a look at some areas that you can increase your margins around this time as this happens. But before we do that, let's just take a look at the overall market. So right here behind us, we've got tender rejections in blue still continuing to plummet from their spike right around Christmas and New Year's. So we hit that high point right around 13.5%, 14%, and right now we're sitting just below 8%, which is the lowest it's been this year now. So as that continues to fall, you're going to have to push carrier rates down in order to create margins. So we'll take a look at some markets that are continuing to fall, and we'll show you how you can boost margins. Now, on the green line here, we've got the outbound volume levels in the United States right now. So that green line here is continuing to go up. So your volume levels over here sitting right a little above 8,200 on the index scale. So we saw this big plummet here right before the New Year's, and we're beginning to continue to creep back up as shippers get back into the swing of things and start moving freight. If you're wondering why we didn't see the massive, right here is this Thanksgiving dip and we had a quick recovery, that's just because they're getting ready for the Christmas holiday. So that's not the case now. There's no urgency to get freight moved, so you'll slowly continue to see that line creep back up. And as that happens, you'll have more and more freight to move. But there are some areas of the country that are moving more freight, so we're going to take a look at those areas and show you where you can focus some of your calls for today to hopefully pick up a few extra loads. So behind me here is the map today, and this is the weekly outbound tender volume change, so the 7-day change on volume. So the areas in blue are markets that are increasing volume, and the markets in red are seeing contraction over the last week in volume. Right now, these are relative to their own markets, so doesn't mean that up here in North Dakota there's not more volume to move than down here in LA, that's red. What it means is that there is more volume relative to that market. So if you're looking for some areas to increase, to focus some sales calls today, I focus on some of these blue markets. There's a lot of blue in Texas, also in the Tennessee, Mississippi, Alabama regions. There's a little bit there in kind of the middle of California, as well as in Arizona, Phoenix area. So you're seeing some blue in those areas. So if you're trying to focus your sales calls today, those are some areas that I would focus on. Stay away from the red areas. Their volume's going down. There's less loads. So if you're looking to pick up a couple extra loads, focus on some of those blue areas there. Now, the market that we're going to take a look at today is Dallas. All right, so right here we've got the van outbound tender rejections in blue. So we saw this big spike hit just under 12.5% there right around New Year's, and then we're continuing to fall. As this happens, as you continue to go down, we're sitting right about 4.4% right now. As that continues to go down, you're going to push your carrier rates down. The market is softening. They'll be willing to take those loads for a little bit less. So whatever you were paying your loads or your carriers yesterday on loads out of Dallas for driving, lower it today. You don't want to pay the same amount. That means you're overpaying. You're leaving margins on the table. As the market continues to soften after this new year, that's how you're going to have to create margins until things start to pick up. Now, and then this green line is just reefer tender rejection. So it's remained relatively flat this whole time, especially through Dallas. Not a lot going on for reefer activity. So if you're moving reefer freight, probably not going to see much change day to day. So we'll continue to take a look at this. Now, one thing that we are going to take a look at as our predictive rating tool for the Dallas to LA market lane. That's one of the highest trafficked lanes out of Dallas. And we're going to see here, if you see where we are today, we're going to focus on the median price today. So we're sitting right around $1.48. That is a line haul item, so there's no fuel added in. So be sure to add your fuel surcharges to get your all-in number. But it's looking at $1.48 today. If we look at the 1 week out price, you're sitting at about $1.43. Okay, so there is going to be continued downward pressure on pricing, all right? So if you're moving Freight on this lane from Dallas to LA, we see the tender rejections still falling, so it looks like they're probably going to continue to fall about a week out, and even a month out. We see that we hit about $1.40, and it's not until we hit the end of Q1 that it looks like rates will be beginning to start moving back up again. So not a lot of surprise there, but if you are moving freight on that lane, just keep a quick eye on it. These are your predictive rates, so it should give you a real good idea of where you want to be pricing yourself today, as well as about a week and a month out. I'm Luke, that's your broker update for today, and thanks for tuning in.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the Freight Tech Revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
Hi, I'm Anthony Smith, and I'm bringing you a bit of a shipper econ update. So behind me, I have durable goods new orders, and looking at the manufacturing segment as a whole. Now, this is something we spoke about recently, just yesterday in the last episode, when we had Andrew Cox here, and he spoke to us about the Institute for Manufacturing's ISM. And so when we're looking at that, when we're looking at their PMI, we saw that there was a lot of decline and contraction within the market, 5 consecutive months of downward movement. So when we're looking at actual factory new orders, this starts to get into that tangible territory. And what we're seeing in the orders is that this is down for 3 of the last 4 months. And so November, the most recent month from the Census Bureau, is no different. We see a 0.7 decline. Now, when we're looking at it, there are different layers for new orders when we're looking at factory orders. And one of the layers that really dropped in the recent month was coming from transportation equipment. Now, this is going to be tied to a lot of the decline coming from the Boeing and the suspension of the production of the 737 MAX. And so that really hit orders hard, especially for that component of orders for durable goods. Now, one of the things that I really look at durable goods for is because it has implications for shipments, right? So these things get placed on order, the production goes into place, and then these things get shipped throughout the country, right? And so when we're looking at shipments throughout the country, that's going to have implications for freight as well. And we're looking at trailers that haul these goods, whether it's in the early stages of production, raw materials, to final transit. And so we're looking at orders. It's very, very pivotal for freight and shipment movements when we're looking at that. Now, one of the bright spots was coming from non-durable goods production. It made a small increase for the month, but it was still down year over year. One of the bright spots for sure, though, was coming from non-defense capital goods new orders, excluding aircraft. Bit of a mouthful. When we're looking at non-defense capital goods new orders without aircraft, this does a few things. So we're looking at non-defense capital goods. So the defensive side starts to bring in some volatility. Another part that brings in some volatility is the aircraft part. And so when we're excluding those two things out, we're really getting out a lot of the volatility in these two indices that would really kind of shake the underlying trend and really make it a little bit more difficult to see what's actually going on. And so when we're looking at year-over-year change for non-defense capital goods new orders excluding aircraft, we're seeing that this just had the second month of rise on a month-to-month basis. Now, there's no catch here. It's also up on a year-over-year basis as well, as you can see behind me. And so what this is also a nice measure of is business-to-business activity. And when we see more and more business-to-business activity come online, that's going to also have implications for freight. And so you can kind of see this as a bit of a silver lining in the overt decline overall for manufacturing. And when we're looking at manufacturing as overall, this is one of the things that we looked at is that it's going to have a lot of negative activity, especially in the first few months of the year. Now, when we're looking at orders, typically this is going to lead production by 2 to 3 months. And now from production, that's going to have 1 to 2 months into shipments. And so this is something that's really starting to build out that expectation that there is going to be some some rainbows on the other side of this thing, that we're going to have a little bit of a stronger second half of 2020. Now, this is just the second month of increase, and so it's a little bit too early to call it an overall trend just yet, but this is something to keep our eye on. This is one of the areas that we were looking at last month. We're looking at business-to-business activity, and there's going to be some upward battles here, uphill battles here, sorry. We're looking at business-to-business activity. A lot of that's going to be coming from headwinds. We're looking at trade conflicts, but there is some optimism building with the expectations of a trade one deal. So this is one of the areas that we're going to be looking at closely in the coming months, and we will be sure to keep you updated on all the most recent movements and how it's going to impact freight. And so that's going to do it for this segment of the Shipper Update, and that's also going to bring us to the end of this episode of FreightWaves Now. The content doesn't stop here. We're always posting around the clock, so check us out on any of your favorite social media platforms. Also, we just launched FreightWaves TV app, and it's available on all your favorite streaming platforms as well, including Apple TV. We'll be sure to keep you posted, and we'll see you on the next episode. Thanks so much for tuning in.
FreightWaves continues to follow the incredibly sad story of Indianapolis-based carrier Celadon Group abruptly shutting its doors, leaving 4,000 people without jobs weeks before Christmas. We here at FreightWaves want to help. FreightWaves has established a free job board for companies to post their openings and for people looking for employment in the freight industry to share their resumes. There's no cost for anyone to participate. Hundreds of jobs have already been added to the site since it went live on Monday. If you're looking for employment or have a job to post, head to freightwaves.careers.